Good morning, and welcome to today's webcast, Investing Insights, Macro and Markets. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Michelle Walker, Chief Investment Officer, and Dominic Cellitti, Senior Financial Advisor. With that, I'll turn it over to Dominic to get the presentation started.
Yeah, good morning, everyone, and welcome to another installment of Macro and Markets. I'm Dominic Cellitti, Senior Financial Advisor with Moss Adams Wealth Advisors, and I'm joined as always by our Chief Investment Officer, Michelle Walker. We appreciate you joining us today as we will discuss what we saw in Q3, what's going on in the markets now, and where we see opportunities ahead. So let's get to it here. To kick us off on the first chart here, we see that the bull rally has marched on. For the third quarter, the S&P 500 was up 5.1%. The tech-heavy NASDAQ was up 2.6%. And the Russell 2000, comprised of small-cap companies, was up 8.9%. This means on a year-to-date basis, we have seen returns of 22.7%, 23.5%, and 10.5%, respectively. Bonds, on the other hand, have had quite an interesting year, with the aggregate bond index returning 4.3% in the third quarter, but essentially flat year to date. So overall, the markets continue to reward investors and have seemingly shaken off a number of macroeconomic and geopolitical risks. But as we know, there's a lot more that happens when we look under the proverbial hood of the market. So, Michelle, what did we see in the third quarter?
Yeah, sure, Dominic. Let's go ahead and take a look back. It was a pretty volatile summer, actually, as stocks experienced some of their best and worst days in years. And for a little bit, it actually appeared like the bull market was at risk as investors once again went on recession watch. In early August, stocks took a dive after a disappointing jobs report, which was followed by a pretty meaningful downward revision from the Labor Department on the overall jobs added for the year. And this caused some fears that the labor market was weakening too quickly. The market sell-off was also just further exacerbated by this global unwind of a popular trade called the yen carry trade, which you all may have heard about on the news. This swing was pretty brief, though, but it did deliver an 8.5% drawdown in the S&P 500. But markets quickly did recover as the Federal Reserve came out on the offensive, clearly communicating it was time to cut rates. At the Jackson Hole Economic Symposium in August, Federal Reserve Chairman Jerome Powell emphasized that the FOMC did not seek or welcome further cooling of the labor market. So with inflation moderating toward the Fed's 2% target, the FOMC surprised the markets with a jumbo-sized 50 basis point rate cut at their September meeting, signaling that they were clearly shifting to supporting the economy over fighting inflation. Of course, stocks do love a rate cut, so we were back to the races, and under the surface, there was a very healthy expansion of market breadth. The shift involved a rotation from the major technology companies that dominated during the second quarter to parts of the market that had really underperformed, areas such as small caps and mid caps, and economically sensitive areas like financials, materials, real estate, and industrials. Utilities were actually the best performing sector during the quarter, and that was due to a variety of things, including lower interest rates, easing inflation, but most importantly, increasing demand for electricity. And we're going to talk more about this a little bit later in the presentation.
All right, so as Michelle mentioned, at the September Fed meeting, we saw our first rate cut after one of the fastest rate hiking cycles, which was then followed by one of the longest interest rate plateaus in history. And more often than not, these cuts have been preempted or executed in conjunction with an economic scare or some sort of exogenous event. But so far this time around, this hasn't really been the case. So, Michelle, can you tell us what we're seeing in the economic data and what might have been a catalyst for this shift in policy outside of just inflation normalizing?
Yeah, that's exactly right. Typically, the Federal Reserve will start cutting rates when many economic indicators are lining up to show weakness. And often that's when it's too late. However, that wasn't the case this time. While we did get that brief scare on the employment front in August, many other indicators were still showing signs of health, including consumer spending and various other cyclical indicators. And as you can see in the chart here, the employment data point was not followed up by further weakness. In fact, in the most recent jobs report, we got a really pleasant surprise with the economy adding 254,000 jobs in September, and that was well above expectations. And the unemployment rate dropped back down to 4.1%. In addition, wages grew at 3.9%, which is substantially better than inflation. So real wages remained positive, which lends further support to the consumer. And speaking of inflation, after a fairly bumpy start to the year, inflation has made meaningful progress towards the 2% target of the Federal Reserve. You can see here that headline CPI fell to 2.4% year over year in September, its lowest point since early 2021. So core goods prices have trended lower for 7 consecutive months now, as supply chains have remained well managed, even with elevated geopolitical tensions. On the more volatile components, lower gasoline prices throughout the summer kept energy prices in check, while food inflation remained mild. Moving forward, sluggish global demand will likely limit a surge in either of these categories in the near term, in our view. And that brings us to the stickiest segment of inflation, which is shelter. So shelter inflation accounts for about 1/3 of the CPI basket and has held stubbornly above its pre-pandemic levels. That said, real-time measures of market rents point to more normal levels of shelter inflation ahead.
Yeah, and I know I briefly touched on this last time, but I think it's important to understand that there's not only a lag in shelter costs, but also there's discrepancies in how it's actually measured. So you're given the differences between renters and owners. So in short, I would suggest this is certainly an area of inflation and CPI that looks much worse than it really is, and is largely keeping headline CPI numbers elevated when in reality they've really cooled a lot more. But let's move on to GDP here.
Yeah, so on this next slide, we'll take a quick look at economic growth. So the US economy grew in the second quarter at a really respectable 3% annualized pace. While inventory accumulation was a large contributor, underlying demand was robust, with consumer spending rising 2.8%. Q3 GDP growth is looking like it will also come in well above 2% when released in about a week. I checked the Atlanta Fed GDP Now estimate this morning, and it's suggesting a print around 3.4% after incorporating the most recent economic inputs. This next slide looks at several key cyclical areas of the economy, including residential investment, business fixed income, light vehicle sales, and the business inventory to sales ratio. Currently, none of these sectors look either really depressed or overextended. Residential investment and vehicle sales are near average levels, signaling that excessive home building is not really a problem at the moment and consumers are in decent shape. Business spending is looking in line with historical averages, and businesses are not accumulating excessive amounts of inventory. So really, overall, none of these sectors look either too hot or too cold, suggesting that the cyclical parts of the economy might be just about right for that soft landing. So Dominic, I know you follow the consumer closely. What do you see going on there?
Yeah, so this time around, I'm going to start with how the consumer is actually feeling first. So as we can see on the chart here on the far right, we're currently still below the long-term consumer confidence average. But the good news is we're off the confidence lows, which were brought on by recent inflation highs. But we still have not really broken that trend that we've been in since the spring of 2020. The big caveat here is that the consumer is actually the consumer doing and what are they doing? And they're still spending. There's no surprise, in my opinion, the consumer continues to spend because U.S. consumers love to spend money. It's basically inherent in our culture. And we continue to see that when we look back at the components of GDP. So GDP here, as we mentioned, is more than 2/3 driven by the consumer spending. And that component of GDP rose quarter over quarter. On a seasonally adjusted basis, we continue to trend upwards, albeit with some slowing, but still moving in the right direction. Now, some might suggest this is from forced increases in spending due to the effects of inflation. But as Michelle pointed out, our inflation is actually under wage growth. So wage growth is exceeding inflation, with inflation continuing to moderate. And it's in fact, wage growth is now nearly twice as much as inflation. So there's certainly more room for the consumer to continue this trend in spending. Now, could this mean the consumer is simply racking up more debt? Well, when we look at the consumer balance sheet as a whole, it still looks pretty healthy to me. So on the left side of the slide here, we see that liabilities represent around 11% of consumer assets, and a majority of those liabilities are backed by real assets versus anything that's unsecured, like consumer credit. So on the whole, this tells me that the consumer is not over leveraged right now. The right two graphs show us some trends that could be a bit more concerning if they persist, in my opinion. So if we look at the top, household debt service ratios continue to climb slowly, but not to a level that is concerning yet. At this point, we're still below historical averages, and some of these recent rises are attributable to anomalies in economic data from a few COVID years that I'm sure we all experienced. A similar story holds true when we look below at the rise in loan delinquencies. And I discussed this on our last webcast, and these still have somewhat risen a bit, but by a de minimis amount at this point. However, a concern I would have here is if these delinquencies continue to lead to a systemic failure, meaning they could bleed into other parts of the financial system. But at this point, I don't really think it's likely. The nominal amount of these delinquencies are not substantial in nature. And the frequencies you see here on the chart are vastly overstating the actual nominal amount of these loans given their size. So this is a data point, though. If it continues to persist, I would continue to monitor it, given the cascading effects that would have on the greater economic growth. Delinquencies only mean that lower spending is going to continue up the economic scale. So overall, the consumer's pretty healthy. The caveat here is that the vibes, as they say, continue to be off, as some are looking at. If you look at the data, it would tell you consumers are better off financially than they've been in a long time. We've seen substantial asset growth across the board. And the positive here is that, the lower half of households have actually seen a lot of the significant growth in assets from a percentage standpoint the past 2 years. If you couple this with higher wage growth, which we already talked about, it's actually occurring more on the lower end of the income spectrum versus white collar jobs. So we're seeing this economic growth across the board. I think there's a few things, though, that continue to get in the way and result in the lower consumer sentiment that we're seeing. Kind of beating a dead horse here, but the overhang from inflation is probably the biggest one. We still just haven't adjusted to higher prices, and we can continue to see higher wages close that gap, though. It's just going to take time. But I think we're seeing improvement, and people are starting to get normalized to these higher prices. And also, most recently, politics, which we'll touch on a bit later with the election. But it's election year. We're 2 weeks away. And on top of the usual negative headlines that we always see, and remember, bearish news sells, we're, of course, compounded by further reminders of all the risks that we've already experienced and those that could come at any time. So, in short, it continues to feel like things are a bit off and the consumer's not doing so well if things aren't outright bad. But when you actually look at the data, the facts say something quite different.
Thanks, Dominic. So, that's good news. It seems like for the most part, the consumer is in pretty good shape. So switching over to the Fed and the outlook for interest rates going forward, I know you had some strong views here during our last webcast. So what are your thoughts now?
Yeah, so, the Fed finally listened to me and they cut the week of our last webcast in July. Just kidding. As we know, the Fed cut by 50 basis points at their September meeting, but that officially begins a rate cutting cycle. And at this point, it looks like they're going to cut twice more this year and possibly another 4 times in 2025, but that's yet to be seen. So the big question would be, what happens to stocks and bonds when the Fed begins cutting interest rates? I'd say the biggest thing to keep in mind here would be the why, as well as the economic backdrop of the first cut and the remainder of this cutting cycle. As always, what typically happens is answered by, it depends. In this instance, it depends on why we cut in the first place. Did we have to cut, or can we cut is really the way I look at it. So looking at the chart here, we see the returns of the S&P 500 on the left, which represents the stock universe for us, and the 10-year treasury on the right, which will represent the bond universe. So starting with the first cut and looking out 2 years, what do we see? It's largely positive returns. If you look at the immediate or short-term response, we see a majority of the time there are positive returns in stocks and bonds, and this just continues to get amplified the further we look out. So starting with bonds, this certainly holds true a vast majority of the time with positive returns. So we look at the treasury side of the chart here. Simple virtue of yields being down means prices will be up, should explain the whole story. In other words, comparable yield available in the market is lower than where you bought your bonds. So your bonds are now worth more. It's a nice little compliment to a decent coupon you're probably already clipping. On the other hand, stocks have a similar story, but with some caveats. So let me explain. And this is where the why of cutting is even more important. Market environments like 2001 and 2007 are prime examples of having to cut, whether that's an economic bubble, housing market collapse, the great financial crisis, or some sort of geopolitical turmoil. You have a Fed that is dealing with crises of various types reactively. So in these examples, the economy had already turned, and the market is responding to peril that could and did follow. So the Fed is responding instead of being in the driver's seat. They had to cut. So whether some of these instances could have been foreseen is another conversation. But what we would hope for this time around is a scenario similar to 1995, for example. We have a Fed that recognizes they've been restrictive enough, and now the risk would be laying on the brakes for too long. Increasing unemployment, which in turn becomes detrimental to growth and eventually putting us into recession. Those consumer confidence and sentiment levels would drop. So threading the proverbial needle would be the soft landing scenario we've all heard of. This would be lowering rates like we're doing now before we need them lowered, but not having a lead foot on the accelerator. That could ultimately bring back inflation and could lead to other economic peril for us. So with that being said, Michelle's going to walk us through some specific areas of the market and how they react during rate cutting cycles like this one.
Yeah, so as Dominic just described, history would suggest that we're in a pretty good place for risk assets right now, but where are the specific opportunities? I would argue that there are some sectors that look attractive on a tactical basis and others that are attractive due to more like long-term secular trends. So starting with the tactical, typically when the Federal Reserve is cutting rates, it is supportive for companies or investments that use financial leverage in their business model. And why is that? Leveraged companies tend to perform better in a declining interest rate environment because lower rates directly reduce their debt servicing costs, freeing up more cash flow that they can use for operations or investments or increasing profitability, essentially making their existing debt burden less burdensome. And this is especially true for companies with floating rate debt, which directly adjusts lower to rates. These more leveraged strategies would include a lot of small and mid-cap companies, real estate, and longer duration assets like unprofitable tech and biotech. Additionally, economically sensitive sectors generally perform well in a declining rate environment, and that's because the Fed is no longer trying to restrain economic growth. So sectors that are economically sensitive would include industrials, financials, and materials. So it's actually not too surprising that since the Fed's 50 basis rate cut in September, these leveraged and economically sensitive sectors have performed very well. So flipping from the more interest rate sensitive parts of the market, or what I would call tactical plays, there continue to be sectors where we believe we are benefiting from long-term secular trends. And we've talked about these before. Business spending remains robust due to strong corporate balance sheets, government incentives, and of course, the surging demand for technology. This next chart shows that business capital expenditures is expected to grow substantially through 2026, with sectors such as communication services and IT equipment, as well as semiconductors, already having benefited. In the future, though, we would expect other sectors to benefit as we move toward the more corporate application phase of this technology spend. In the bottom right of this chart, you can see the AI adopters today who will be benefiting from their margin-enhancing investments in the future. These sectors include professional and technical services, educational services, finance and insurance companies, and healthcare, among many others. One expected outcome from this build-out of infrastructure is a huge increase in the global demand for electricity. You can see here where this will come in large part from the build-out of data centers and to some degree electric vehicle charging points, and that's in the bottom right. You may have also seen in the news recently multiple reports of big tech companies, including Amazon and Microsoft, Google, and Oracle, making plays right now to shore up future power needs. In some cases, partnering with specific utility companies to ensure access to clean energy like wind, solar, and nuclear power. In September, Microsoft signed a 20-year power purchase agreement with Constellation Energy that will pave the way for the launch of the Crane Clean Energy Center and will include a restart of part of the 3 Mile Island nuclear power plant in Pennsylvania. Just last week, Amazon said that it was investing in small nuclear reactors, coming just a couple days after announcement by Google saying the same, as both tech giants seek new sources of carbon-free electricity to meet surging demand from data centers and artificial intelligence. As I mentioned earlier in the presentation, utilities were the best performing asset class during Q3, and that was largely due to this increased expectation around future demand for power. So with the Fed in rate cutting mode and some very important secular trends at our back, we think there's a lot of areas for opportunity. Of course, there are still headwinds and uncertainty. And on that front, Dominic, let's jump into the election.
Yeah, so we have less than 2 weeks left of political ads and lawn signs. And I'm not sure about everybody else, but I'm ready for it to be over. So I'll be brief in this subject. I know last time I walked everyone through some election year returns and how they fare versus other years. And just as a reminder, we ultimately found out there's really no difference between election years and other years in the market, regardless of the party that wins or the heated rhetoric of the time. Any election year playbook you come across, in my opinion, is a gamble. So staying the course with the long-term plan is what's most important. Bottom line here would be don't mix your portfolio and your politics. So at this point, though, we do have some more substance to the two candidates' policy platforms, and not trying to get ahead of any reaction in the market, but just want to briefly run through some of those that have direct financial implications either to the economy or the market. So from a potential Trump administration, these would include no tax on tips for service workers, the largest one being the possibility of the extension or permanence of the Tax Cuts and Jobs Act's components, which amongst many include higher state exemptions, SALT deduction limitations, lower income taxes on individuals, and some other business-friendly components. Tariffs. Similar to last time in office, there's been a promise of the use of tariffs. It's yet to be seen whether these would be used as a bargaining chip or actually implemented. Then overall, we've just heard more of a domestic focus and protectionism stance when it comes to trade and the economy. The other side, with a potential Harris administration, this would also include a promise that no tax on tips for service workers. However, we'd be looking at the possibility of sunsetting of components of the same Tax Cuts and Jobs Act, meaning the lowering of the estate exemption, income tax rates possibly increasing, amongst other tax law changes that were not made permanent as part of that act. We also hear talks of corporate tax increases, and also, however unrealistic in my opinion, mentions of unrealized capital gains taxes. And in summary, overall, we've heard a tone that has a much more global trade partnership focus as opposed to the nationalist focus of the Trump administration. What's most interesting to me is that both Canada's platforms include substantial stimulative policies that would likely increase spending, and neither have addressed, really even mentioned, the national debt. And if you paid attention to yields in the past few days, we've seen a rise in the 10-year Treasury, given the possible impact of both sides on the national debt. So just to conclude here, as I'm sure we all know, it would take control of both Congress and the White House, my opinion, to really execute fully on any of these policy platforms in any sort of outright manner, which it means it's quite probable that we'll have minimal change, if not some compromise. And as we know, the market does love a mixed government because there's less uncertainty. All right, moving on. So let's pivot to private investments. Michelle and I and the rest of our team continue to get more questions about private and alternative investments than really any other subject these days. If you read or listen to any financial news, it's pretty hard to avoid the subject. But luckily, we've been on the forefront of helping clients assess private investments, not just how to include them, but whether it's even appropriate and at what level. So, Michelle, can you remind everyone about the benefits of adding private investments to a portfolio?
Yeah, so we've talked about this before, but investors that are willing to venture outside of the public markets can leverage, a lot of different alternative assets to reach their goals. And so looking at this slide here, private or alternative assets can offer low correlations to public markets, diversified income streams, and the potential for enhanced long-term returns. Looking at some of the different categories, real assets shown towards the left here, such as real estate, infrastructure, and transports, tends to be less correlated to a traditional, mixed, say, 60-40 stock bond portfolio, while providing robust income. Private equity and venture capital over towards the right could provide much higher total returns, but comes with higher correlations to public markets and less income generation. And though we think the classic 60-40 stock bond portfolio still looks very attractive, we do believe adding a sleeve of alternatives can help long-term investors achieve strategic goals through higher overall returns, better diversification, and enhanced income. Dominic, what are you liking in private investments these days?
Yeah, happy to answer that. Just before I get into specific asset classes, just want to say, I know, Michelle, this is one of my favorite areas of investing to talk about and work on for our clients. So I actually just spent the last few weeks at a few different private investment conferences, working with other advisory firms and private investment fund managers. And I couldn't be more excited about the space and the benefits that it brings to a client's portfolio. So just to preface, of course, as always, beyond the benefits you mentioned, I think it's vital to remind everyone that public markets continue to shrink. Private companies are staying private longer or simply have no appetite to go public. It's easier than ever to access capital on either the equity or the debt side, and there's more focus on the actual business than short-term stock prices, which can lead to more efficiency in the private market, regardless of the asset class that we're talking about. So as usual, a few things I want to point out from a risk perspective. Liquidity. Private investments have liquidity constraints that investors need to be aware of and are different than public investments. You also have increased risk in certain asset classes. Venture capital, for example, where you have a greater opportunity for a complete loss of your principal investment. Manager selection. This is absolutely paramount, in my opinion. As we see on the chart here, the dispersion of returns for public investment managers is pretty small. And this means that a lot of your risk simply lies in the market, as opposed to the specific fund manager. On the private side, on the right side of the chart here, you see a substantially larger dispersion. This demonstrates that manager choice is of utmost importance, in my opinion, when you're looking at private assets. Finally, working with an experienced advisory team to discuss how to allocate in order to complement an existing public portfolio, account for your specific illiquidity provisions, and ultimately select the appropriate components, whether that's the asset classes themselves or the specific access through a certain fund manager. All right, with all this being said, here are the areas I like right now. Real estate. Central bank rate cuts are kicking in many parts of the world. So with the expected decline in borrowing costs, it should create a great tailwind for high quality real estate due to its sensitivity to interest rates. We've already seen some pretty healthy repricing, and a lot of the risk in this space were largely confined to metropolitan office space. Another one would be private infrastructure. This is definitely a newer asset class, especially on the private side. It has a low downside capture, meaning that if the market takes a dive, it doesn't always represent that same downside. So it can help buffer portfolios during extreme periods of volatility in other parts of your portfolio. Additionally, we're pretty bullish on infrastructure energy assets, as Michelle previously mentioned. We have AI's rapid expansion, which is creating immense demand. Data centers and AI technologies, continue to need consistent and reliable power. On top of this, you have the federal government has earmarked $1.2 trillion for infrastructure spending. And this does not include the vast amount of spending in the private sector. Infrastructure is our lifeline, and numerous states and municipalities haven't really addressed a lot of infrastructure projects that need to happen. So I think there's a lot of tailwind in infrastructure. Private credit. Yields on private credit remain attractive. However, there's some elevated macro uncertainty that suggests choosing private credit funds with robust asset management capabilities remains critical. This is definitely a space that's grown in popularity, and we see it all over the headlines. Investors need to know what they're investing in and with whom, for sure. Finally, private equity. With lower rates, private equity is starting to look quite attractive again, in my opinion. You have capital markets opening up, and private equity is being seen as the more attractive, convenient, and really accessible capital opportunity for owners or executives versus IPOs. Additionally, you have a lot of opportunities in private equity secondaries. So these would be investments that are trading hands because a previous investor has a liquidity need and mismanaged, their timeline. So a manager is able to step in and take advantage of a great pricing opportunity. Just to round us out here on the private front as a whole, in case, we need more evidence that the benefit of capital markets are reopening, and the general prevalence of private markets, I'd look no further than the top asset manager stocks that operate in the space. They've seen a meteoric rise as of recent with the substantial demand and kind of long runway that's pouring into these asset classes. And the shift that's really a fundamental shift, I would say, that's really occurring between public and private markets.
Yeah, thanks for that, Dominic. It's super interesting stuff. We're getting close to the time to end the broadcast. So just for a quick recap, in the third quarter, stocks once again successfully climbed a wall of macro worries, even as consumers, were worried over a softening labor market early on in the summer. As stocks rebounded from that August swoon, though, supported by an outsized Fed rate cut, the market breadth improved with more economically sensitive sectors outperforming. And we see that as a very healthy trend that's probably likely to continue. For the remainder of the year, we expect sustained growth, albeit at a moderating pace. Favorable inflation data and economic indicators in the coming months should enable the Fed to persist in its rate cutting cycle. And we do believe that the historical trend of a strong start to the year, coupled with modest inflation and economic expansion, positive earnings guidance, and the real kicker of a Fed in easing mode positions risk assets favorably for the remainder of the year.
Yeah, I couldn't agree more, Michelle. I know this brings us to the end of our prepared comments, and we appreciate everyone joining today. But we do have some time to answer a few questions. I know there's a few in the chat, so if anybody else wants to add any, feel free to go ahead, and we'll talk through some of these.
Yeah, so I see a good one here, Dominic. Someone is asking, it's a great question, isn't it risky to be investing at all-time highs? I keep hearing multiple suggest that the market is expensive. What are your thoughts here?
Yeah, so I guess there's two parts of that. There's the all-time highs, which in my opinion, if you look at the market grows over time. And all-time highs are essentially a factor of the market. I think we actually have a chart here we didn't spend too much time on, but I'll use this as an example. Um, Investing at all-time highs, as you see, I believe it's on the right side there. It essentially over time has better returns. And again, that's because the market continues to go up, and we have growth in the market. So I wouldn't let all-time highs really persuade you not to invest in the market. On the other side, investing based off of multiples really has no statistical proof of whether investing at low or high multiples is better or worse. Multiples have changed over time. We've seen increases in multiples, and a lot of that has to do with higher efficiency in the components of the market. Some of the biggest companies, and I know we've talked about this in previous webcasts, have some of the strongest earnings growth and margins out there. So they have multiples that, in my opinion, they deserve. They're cash generating machines. But simply looking at the market and trying to solely invest off of multiples, in my opinion, is kind of a mistake. Multiples can grow out of their current valuations by earnings growth. So it doesn't mean that multiples will compress simply by a sell-off in the market. Let me see here. So got a question about international stocks. So it seems we've talked a lot about the U.S. What are you seeing going on outside the U.S., Michelle?
Yeah, sure. So markets outside of the United States have also shown resilience for sure, despite some pockets of weakness. Emerging markets, particularly India, have demonstrated really strong growth. Developed markets have been kind of mixed in performance. Europe, with its focus on manufacturing, has faced some challenges. In China, the ongoing real estate downturn is affecting growth. Inflation's been hovering around zero, and domestic demand remains pretty low. However, actually really recently, the government has had some intervention tactics and some stimulus measures they've imposed, and that may boost sentiment and stabilize growth in that region. And so that remains to be seen in China. In other parts of Asia, Taiwan and South Korea have experienced renewed growth in the tech and electronic sector. And though it's been, kind of a mixed bag, we do think as global central banks, continue to ease monetary policy and inflation trends back to more manageable levels, that we'll continue to see global risk assets, to do pretty well, as well as the U.S.
Yeah, I'd point out, I know China's been considered uninvestable these days, and that trend in the last month seemed to have changed a bit. In my opinion, it's a little concerning when a government has to intervene and essentially put a market floor in as far as how much confidence I have. I know they've tried these tactics in the past and they haven't always panned out, but certainly do think there's areas in the international market that make sense and are great opportunities, like emerging markets for sure. So I think this is a pretty timely one, Michelle, here in regards to rates. And I know I touched on it briefly, but there's a few components here. So the question is, why are we seeing Treasury rates go up when the Fed is cutting short-term rates?
Yeah, that has been a little bit of a head scratcher. So the 10-year yield has backed up quite a bit from around 3.65% in the middle of September, right around that rate cut, to almost back to like 4.25% today. And the reasons seem to be many, including the economic data has been stronger. And with the Fed cutting short-term rates, it seems like investors are no longer in that, worrying about an impending recession mode. Also, and you touched on this earlier with, the election getting very close, I think there are concerns that really neither candidate's policies will be particularly good for inflation or reducing the deficit. Obviously for different reasons, neither one of them seem really inclined to be, deflationary or, in a mode to reduce the deficit. So I guess we'll see on that front.
Yeah, couldn't agree more. I think this is another interesting one here, and happy to take it. When do you see the IPO market reopening? I'd say early to mid 2025 is probably the most likely. I know we saw a handful of IPOs this year. You have some shelf registration type IPOs that are essentially not as large. But when are we going to get back to some robust offerings? Certainly, I believe that's happening next year. Big topic of conversation in the asset managers and private equity managers that I had some exposure to the last few weeks. You also see a substantial number of investment banks, adding to those M&A teams that are bringing companies to market. So I think we are on the cusp of that happening. Only would be sped up by additional rate cuts and a more attractive multiple environment for some of these firms that are going to be going public. So.
Yeah, I would agree on all fronts. And, one other thing that we do know is the stock market tends to sniff out these trends before they're really, really raging and robust. And like you mentioned earlier, the asset managers have been on a real tear. And I think that's expecting a lot more activity in 2025 in, the private market and the IPO market and private equity in general.
Looks like we have one question. Happy to answer it first here and then get your opinion, Michelle. So any comment on the recent Goldman Sachs forecast that the S&P will have 3% returns over the next 10 years? I don't know about you, Michelle, but I tend to take forecast with a substantial grain of salt, whether it's a one-year forecast on the market indices or any type of long-term forecast. In my opinion, it's pretty easy to set a bearish forecast because it sounds more intelligent, in my opinion, than the bullishness of looking at long-term investing. But I don't have too much faith in a 10-year forecast, let alone what's going to happen 365 days from now. I think that's probably due to current market multiples, which we already discussed. We can easily grow our way out of that with earnings growth. And also just general all-time high of the markets, which we also discussed as well. I think it's just an easy way to forecast based off where the market is. But what do you think about that?
Yeah, I would agree with that. And I can say I think we've been hearing that for about the last decade because we've had really fantastic growth in the stock market due in part to a lot of these secular trends in technology and other parts, of the economy. So, I've been hearing that muted forward-looking, returns for, a very long time, and it hasn't really panned out yet. So I'm with you. I don't really give a lot of credence to like a 10-year projection of that nature, given all the, exciting stuff that's going on in the world.
Yeah. All right. I guess I'll promise last one here since we have about a minute to go. Will the end of either or both of the present wars have an effect on the market? I'd say these wars have largely had minimal impact on the market. I'd say the war in Ukraine probably had some inflationary effects, which were just being exacerbated by existing inflationary issues we were having domestically anyways. But a lot of those have subsided with supply chain issues being mitigated. The war in the Middle East, as unfortunate as any of these wars are, has been substantially isolated to the Middle East. A lot of that prior would have been maybe some energy concerns, creating more inflationary environments from a commodity standpoint. Given our ability to produce a lot of those energy sources domestically, we're fairly isolated from those issues. If it spread, it certainly could create more issues, but I think at this point, there's not substantial upside from these wars being resolved besides the human impact of it. So I'd say from an economic standpoint, I don't know if there's too much of a shift that would happen.
Yeah, I would just add from a sentiment perspective, whenever the market sees, closure on something that's uncertain, it always finds that as, a positive thing. I think we could say the same thing about the election. I think there is a good chance that no matter who wins, just having the, the certainty of the election behind us will probably give a boost to the market. And I do think that if we were to get an end to one of these, conflicts, on a sentiment basis, it would definitely, be a positive, at least for, a boost in confidence.
For sure. I know we're at time, so I appreciate everybody joining us. Michelle, thank you for your time, and I will hand it back to Chad to close us out here.
All right. Thank you, Michelle and Dominic, for a great presentation today. If we didn't have time to answer your questions, we'll do our best to follow up with you after the webcast. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.
Thanks, everyone.